Hey everyone, we'll give everyone a minute or two to join and then we'll get started.
That's good.
Hey everyone.
Hey Bruno, welcome. I think we've got all the partners here, so maybe we'll just dive right into it. So hello everyone, thanks for joining us. Another Meet the VC session sponsored by ourselves at Escalon with Trinet, Decrypted Law, and ARC. We've got Connor Sundberg here from Amplify.LA. So Connor, if you want a quick intro.
Yeah, totally. I'm Connor. I work on the investment team at Amplify. I've been with the team for a bit over 6.5 years now. So first met everyone there in 2016, I think, and then joined the team officially at the end of 2017. Yeah, and I'll kick things back over, but really excited to be here.
Yep, awesome, cool. Thanks, Connor. And we'll give all the partners a chance just to introduce themselves quickly. Kate Kozak with Trinet, why don't you go first and share us a little bit about Trinet?
Yeah, absolutely. Thanks, Mike. Connor, excited to hear what you have to say today with the group. But for those that aren't familiar with Trinet, we are a PEO and we are laser focused on helping small to medium-sized businesses grow and prosper. We use scale and service to transfer all the mundane, not so fun issues of running a small company over to Trinet so that founders can focus on their mission and core values. We're particularly focused in the areas of HR, benefits, and legal and regulatory aspects of the SMBs that we support. And we're unique in that we're verticalized by industry, allowing for us to be a strategic partner to our founders. So excited to be here today. Thanks for having us, guys.
Great. Thank you, Kate. I'll throw it over to Bruno Cunha from ARC.
Hey everyone. So I'm the head of partnerships at ARC. ARC is the future of startup finance. We enable startups to open bank accounts in minutes, manage everyday banking needs, safeguard cash, maximize yield, and access capital all in one platform. So we help founders from all stages, even through incorporation. We're based in NSF and we're backed by Left Lane, NFX, and YC. Happy to be here.
Great. Thanks, Bruno. Last but not least, Alex, you want to jump in?
Yeah, thanks. Yeah, lawyers are never least, guys, at least in our view. So I'm Alex Daniels. I'm one of the founders of Decrypted Law, co-founded by a couple of former Cooley LLP associates. And our goal is really just to modernize the modern legal system. So all of our pricing is either flat rate or subscription based, just to make it a lot more early stage and founder friendly. Me and my colleagues, we've done over $1 billion, $2 billion maybe at this point in financing, number of rounds, and happy to talk to any early stage companies looking to get good legal service, but not have to worry about going to like the ER, so to speak, for their legal needs. Feel free to reach out to our website or reach out on LinkedIn. Our website's decryptedlaw.com, and very happy to be here.
Awesome. All right. Thank you all. So we'll just dive right into it. So just so everyone has the context, Connor Sundberg, like he mentioned, joining us from Amplify.LA, which is a VC firm, kind of a first check firm based in LA. So maybe, Connor, we'll just start. If you could just do a quick overview of Amplify.LA, what your guys' focus areas are, anything else that would be relevant here.
Yeah, happy to. So our story, we're based in LA. We started in 2011, and I think there were really like a couple founding reasons for us being a part of the ecosystem. One of them was that if you looked at like the landscape in 2011, there just wasn't a lot of early stage funding available. You could probably take that more broadly outside of LA and characterize the entire US in that paintbrush. But I think if you looked at it at the time, you had basically incubators and accelerators, and that was the first stop for most founders when they were getting started. And LA had a couple attempts at that, but it didn't really have an early ecosystem to speak of. And so that was the thing that really got us excited. And I think the aspect that compounded that was that we kept finding great teams, and teams would leave to go and raise capital when they were first starting out. And so we had our own mini version of brain drain that we were noticing firsthand. And I think our founding partners had talked to a couple other investors up in the Bay Area, investors in New York, and they all sort of noticed the same thing. I think Uber was a company that was started in LA, funded in San Francisco, just to give one example. But that had happened over and over and over again. And so a lot of the folks that we talked to basically said, until you fix the early stage funding problem in your own ecosystem, you're not going to have much of a developed ecosystem at later stages, at Series A, Series B, and beyond. And so that was what really got us started. Now, if you look at what 2011 looked like in the funding ecosystem, there wasn't a good word for what we were doing. Like I mentioned, there were, incubators, accelerator programs, but folks like that, it was typically a cohort model, right? You get a class of companies together, you all start in, June, you're done in August, they kick you out, you're off on your own. And we always wanted to operate like any other fund. And so we invested on a rolling basis. We meet companies one-off, fund people when we got excited, by the team, by the early traction. And at the time, there was no word for pre-seed. There's no good, fit for us. And so we kind of got lumped into the accelerator category early on. And then it wasn't until like 2015, 2016 that sort of evolved. And we found pre-seed was, the best nomenclature for what we do. But that's a bit of the founding story on us and why we're here.
Okay, that's helpful. And like, we definitely want to dive into like the LA market, what's changed since 2011 or 2016. Yeah. Is there, just so everyone gets to know you, is there a specific focus that you take on within Amplify.LA from an industry standpoint, wherever you want to take it?
Yeah, I guess a bit of added background. We're a very small team, so there's 5 of us. And so I always joke that there's a little bit of the goldfish mentality. So we have short attention spans in some ways, but it's mainly because you see different things on a day-to-day basis. When people ask if we're, thesis driven, if we have a hardcore sector mandate or something like that, the answer is usually no. We're more emergent in the sense that we'll kind of observe what's happening over time. And then as an area kind of bubbles to the top, you just start to see that kind of compound in different sectors. So to talk about it, like when I first joined in 2016, I would say the thing that was in vogue was marketplace. And so you had like Uber as a success story, Airbnb as a success story, and you just saw all these different marketplace models that were happening at that time. Fintech became a much bigger part of the LA ecosystem, 2017, 2018. From there, crypto into 2019, 2020. Now we're in, AI territory. And so there's always like kind of trends that rise to the top. And even aside from like the overarching nationwide trends, we see micro trends because of what LA looks like. So an example recently is people are talking a lot about El Segundo as, an ecosystem for defense, aerospace, heavy manufacturing. And so that's something that we see a ton of recently. A lot of founders in Southern California have really good DNA there. So it kind of, emerges over time for us in different categories. I would say there's categories that I'm more comfortable with personally. Like my background is more finance, fintech, and then I kind of grew up around a healthcare family. And so those are areas that are a little bit more natural, but I also like things that cause me to kind of stray outside of the comfort zone. So I've been doing a lot of cybersecurity in the past year or two, a lot of, manufacturing tech, as we mentioned recently. But yeah, we're definitely generalist as a fund. So we'll look at just about anything.
Okay, great. That's helpful. I'm sure that, it keeps it easy for everyone in this group. We'll shift back to LA before we expand a little bit more broadly, but LA market, pretty interesting what you said, the like brain drain that was happening. A couple big, really successful companies started here. What are you guys thinking about the LA market going forward, the dynamics with bringing in later stage investors to allow people to stay? What's your guys' take on that?
Yeah, it's a really good question. It's one that we get from our LPs, our investors too, is sort of why LA, in the future. It was an easier story to tell in 2011 when you just saw, LA, if you looked at, I think the metric that we were referring to at the time was like net outside capital. And so you could look at an ecosystem in terms of the amount of funding into startups that's coming from local investors versus investors in other ecosystems. And I think if you looked at LA at that time, it was like 80 or 90% of the capital coming from outside of the ecosystem. And so that to us, told the story of like, we need more local funds, right? We need to kind of correct that imbalance. And you could chart ecosystems over time, like as New York matured or San Francisco matured, the share of outside capital, continues to kind of level off and decline versus, the homegrown funds there. And so that's one thing that's been happening since I joined, and I think will continue to happen, is our share of outside capital is sort of decreasing relative to the new funds that are popping up. So new capital coming from local investors. And then I would say the thing that we've really been looking for and are excited about is we still need really good vertical software IPOs. I think the IPO window is a little bit closed off right now, and people are, you ask 1,000 different people, get 1,000 different opinions on when it reopens. But that's one thing that we're excited to see. I think you had a crop of companies that started in 2013, 2014 that are just now getting to the point where they could test the waters in public markets. And when that happens, typically with an ecosystem, you see a ton of capital come back in, right? Because you've just had people, this massive liquidity event that flows to the funds, it flows to the early employees, it flows to new companies. And so those types of events are really meteoric for early ecosystems. And so that's one thing that I think is still very early innings in LA, but we're optimistic in the next 2 to 3 years, you see a lot more of that.
Great. Okay. Well, cool. That makes sense to me, right? And honestly, for people like you guys, like the early stage funds,
Yeah.
there's a light at the end of the tunnel. Right now, if you can't see it, it becomes everyone gets a little bit tighter, I feel like. Which sort of stems to the next question. Like this is the classic question that probably everyone gets asked these days, but how is the VC startup landscape changing in your guys' opinion? There was obviously a bunch more funds a few years ago, but now people are tightening their strings. So
I think, you notice waves over time, I would say. And so I think when I first started 2016, 2017, on the VC side of the fence, we were sort of in the firm building phase. And so you saw a lot of new firms kind of hit the market between that point and 2020. It even accelerated a little bit into 2020 when we had sort of the rip from 20 to 21. And then I think, over time, you're going to see, expansion and consolidation. And so I think a lot of firms will kind of start up, and then it takes 5 to 10 years sometimes to see which firms have staying power, right? We were founded in 2011. We'll have our 13th anniversary this year. And that's, about 5 funds. And so sometimes I think people forget like how long of, a life cycle it is on our side. So our fund 1 in 2011 still has 3 or 4 active companies. And that's something that, we're still waiting for those companies to kind of hit the point where they're either IPOing or looking at late stage M&A. But it can take a really long time for companies to run the entire life cycle. And so I think in that time, you're going to go through different markets. You're going to have periods where capital markets are doing super well, but like periods where it feels, recessionary. And so, you're going to see kind of funding kind of change over time in that way. I think one thing that I've definitely noticed over that, that kind of intervening period is it's gotten way more institutionalized. So I think if you were to look back in 2010, 2011, it was still sort of rare for endowments to be making big venture allocations. And now I'd say if you look at like the LP side, as far as how do VC firms get their capital, that has really broadened. So you have, university endowments, you have public pension funds, you've got, corporate investors that are seeding funds. All of the diversity of capital that's hitting the ecosystem, I think has just meant that the asset class has risen. It's a rising tide lifts all ships phenomenon.
Right.
So I think we've seen a bit of that, and that's flowed through to the managers. And so you see so many more managers from different backgrounds, different expertise areas kind of starting things, which I think is good. It benefits companies, it benefits, startups. You don't want a market that's like, a duopoly, which is what venture looked like. And, if you go rewind the clock 50 years ago, so you had the choice of 2 or 3 firms. And if you didn't get a check from those firms, you were kind of out of luck. So I think it's a great thing to see the ecosystem grow in that way.
Yeah, I tend to agree. I think, Silicon Valley, as it was this best kept secret from an investor standpoint. And you get the institutional capital in, creates a little bit more governance for startups, more awareness for founders. Hey, here's an opportunity if you've got a great idea. All right, I'm going to shift gears into sort of more specific around the companies that you invest in. I'm going to jump a little bit here, Connor, just types of companies you invest in. Like, we talked about it as pre-seed companies. I know you guys think about it as first check. Can you talk a little bit about what qualifies a founder in your guys' view as a pre-seed, first check, whatever you want to call it, like the types of companies you focus on?
Yeah, I saw that question come up in the chat too. So probably good to qualify, what pre-seed even means. The first thing I'll say is nomenclature is definitely a moving target, right? Like part of the thing that we pitched when we first started Amplify was that, the reason for a pre-seed stage to exist is because seed rounds were kind of, graduating on, right? Like if you rewind the clock a decade, it was typical for a founder in an institutional seed round or maybe raise $1 million or $2 million. And that was not uncommon whatsoever. I think YC was writing 7 or 12K checks at the time. And so every stage was kind of like a stage setback, right? And if you looked at a Series A, it was 4 or 5 million. Nowadays, a seed round is 4 or 5 million. You see news announcements of seed rounds that are 20 million or 30 million, right? So you can kind of call it, you can chop up the nomenclature however you want at the end of the day. So what we think of is more of, like, we're looking for a profile of company that you're basically at that inception stage in your life cycle, right? We want to see a team that's just formed. It could be as early as people about to leave their jobs who've just been ideating and working, moonlighting and putting an idea together, all the way to like, for some of our companies, you've tested early proof points, right? You've gotten a little bit of traction in market and you've done a lot to sort of validate your initial thesis. But you need to put fuel on the fire, right? I think the most compelling cases for us when we're looking at companies are when there's sort of, we call them push versus pull factors, right? We don't want it to feel like you're being pushed into the market, like, oh, you got to go and raise. There's this like pull, right? Your customers are asking for more. You have people who are excited to join the mission. There's sort of the sense that like, okay, we're tapping into something here. And that's when, I think venture capital can be used best, right? Like it's really meant to be an accelerant. It means you can hire faster. It means you can, expand. It means you can take on bigger contracts than you would otherwise. It sort of brings you into that next level of, kind of gameplay as a founder. And so that's what we're looking for in the very earliest iterations, is companies that feel like they've just kind of, formed and are starting to find their footing in a market. And I would say that kind of encapsulates what pre-seed is. So I think early on, you see a bit more of a reliance on the qualitative versus the quantitative, right? And then over time, you kind of see that arc change, right? As you get to seed, Series A, Series B, I would say it shifts a bit, right? Like quantitative starts to matter a bunch more. And, the qualitative factor is obviously still important, but by the time you're a Series B, Series C company, people are really digging into metrics, right? They have a lot more to go off of there. And then someone asked about check size, but for us, we'll write a check of anywhere from kind of $250,000 up to about $1 million or 1.25. And so that's sort of our range. And to characterize it more broadly, I would say pre-seed rounds nowadays, anywhere from 250, 500K on the low end to 2.5 million on the high end. That's sort of the, what we're seeing in the market currently.
Okay, great. Thank you. I was going to try to weave that one into the next question. I saw it pop up a couple times, but going back to what you said, qualitative, quantitative, I think everyone can agree on that. Qualitative early on. Could you talk a little bit about like Amplify.LA as a culture? Are there specific founders or qualities in founders that you look for? And then, maybe even riff on, has that changed over the years?
Yeah. And, another question in the chat, which I think is related to that, right? Customer interviews, right? And people asking for like, how many or how much, right? Like, what do we like to see? Sometimes it's not that easy, right? There's not a formula where it's like you've done 10 customer interviews, great. I've always abided by the mantra of do the free things first, right? And I think that's such a leg up as an early founder, right? And we see that in spades when you get on the phone with a founder and they're like, I've been cold calling, cold emailing, reaching out to my network. I've gotten in front of, so many different people in this industry that I can now, really validate some of the early ideas that we've had. And so I think the free things mean the things that it doesn't require a lot of capital to do, right? But those are the things that we like to see proactive founders really attack, right? It's not always like, okay, we're going to, spend $250,000 and hire a couple great engineers, right? But it could be like we're really investing a lot into sort of refining the narrative in the early stage and talking to as many folks as we can to really understand like how this market works and why it works the way that it does. And so I think, when we talk about the qualitative, that's a big part of it. We invest in founders that are really curious about the area that they're building in, which you'd think sounds like a given, right? But occasionally you get on conversations and, you sort of have to ask the question, like, why are you building this, right? Like, why are you invested in this area, this outcome? And so I think, for us, we like to see that sort of, that gravitational pull, right? The person who can make you excited about what they're doing. When I coach our founders about like how to talk about it when they raise, the thing I usually mention is that for most founders, there's like a light bulb moment, right? It's not often just one thing, but it's like a series of kind of realizations, right? That cause you to think this is interesting and want to dig in and build something there. And I think your job when you're pitching, right, is to sort of coach the audience through those same realizations, right? Like when people can arrive at that conclusion with you and sort of have that aha moment during a pitch, that gets us really excited, right? And customer calls are validation of that. When we reach out to customers and we hear the customer kind of saying the same things, validating that version of reality, we get really excited about that.
That's great.
So that's sort of qualitatively, some of what we're thinking
that's
about.
perfect. And it dovetails like into a hopefully pretty helpful question. And maybe we can even take this as like think of it, if people on this call wanted to take notes, but like what does make a motivational pitch, something that, or a pitch that motivates you to want to invest? Like, is there one that comes to mind that they hit the check boxes that you look for? And like, maybe you can even rattle off if there are specific criteria, specific metrics, specific words that you try to hear when a founder is pitching.
Yeah, I would say maybe not as much on specific words, but I definitely think over time, a lot of what we're reading into when we're talking to founders is that sort of like education level. Like if they really spent the time and invested in reaching out to folks and kind of validating their early pitch, that early thesis. And a lot of that comes across on a call, right? When you ask questions and you get the sense that the person can keep diving in, right? Or sometimes we like to ask like addendums to questions, right? It's like someone will give you a surface level answer and you dig in. What's the layer beyond that, right? If someone's willing to pay this much, why are they willing to, right? Why is this such a big problem for them? Why haven't other people, solved this in a way that the market has really latched onto? And I think when people can really kind of move down to second order, third order, that's something that we get really excited about. Transparency is a big thing. Like we don't have issues with people coming to us and saying like, hey, there's not a lot of traction to date, right? We don't have massive enterprise customers paying a lot of money, right? But when they can kind of open the book and say, here are some really good customer conversations that we've had and things that have gotten us excited or formed our thinking, and being willing to like share that information, invite us into that process, I think that is great, right? I've had pitch meetings where right after you have 3 or 4 questions come up and, you reach out to the founder right afterwards and they're fine getting on a call and digging in on it with you, or even, opening up, like connecting you with folks that they've talked to who've really informed their thinking. And so I think that goes really well, right? In our process, we look for people who are excited in that way, right? And want to share that enthusiasm with us. And then on the quantitative side, like quantitative is very different at pre-seed, but I would say we spend a lot of time on market and market size, right? I think one of the things that you realize over time in venture is that there are some markets that just don't play out in venture scale over time, right? And it's not necessarily a bad thing. And there are some times where we have conversations with founders and we think that the best path for the company may not be raising venture for that business, right? Okay. Where it could be that you could grow this into a 10, 20 million revenue software business and have a great outcome that way without having a ton of capital taken into the stack, right? And so I think there are categories that we look at. Like I remember this was a while ago, but probably a year or two back, we were looking at a company that was building software for like art galleries and museums, right? And we all sort of walked away from the conversation being like, this is an amazing business. The founder was great. They knew what they were doing. And it was awesome. But the more we reached into the market and kind of looked at it ourselves, we just realized like, it's not going to be 100 million plus ARR business, right? And that was okay at the end of the day. Founder had raised next to nothing into the business, still running it very profitably today. And so I think you can have great businesses that aren't venture businesses. So we have to spend a lot of time validating market because of that. And it deals with, the fund size that the firm is investing out of, right? Because at the end of the day, there's sort of like a level of returns that we need to hit. And so when we're modeling, like, what are the type of outcomes that support that, you have to look for businesses that can grow to a certain scale. So yeah, okay. That's a lot of what we'd spend time on, quantitatively. And then also just, looking at customers and saying, is there willingness to pay in deeper pockets here, right? Some businesses, you reach out to the procurement teams who would be on the other side and you get a sense that, they might be comfortable paying a couple $1,000s, but they're not going to pay, in the order of 5 or 6 figure ACVs for a product, contract values. And so those are things that we, need to get a better feel on quantitatively.
Okay, that makes sense. And that, I guess, boiling it down then from a qualitative standpoint, basically a founder that knows intimately the problem that they're solving, that the problem that why they believe their company could solve it, and using customer interviews ahead of time can kind of help shape that. And then I like the feedback on the quantitative side. Are you going after a market that's large enough that a venture investor could actually, fit it into their risk model, frankly?
Yeah.
Could I ask?
Because part of
go for it.
Yeah, one thing I'll add to that, right? Part of the logic for that is the next stop after us is typically raising from other investors, right? And the thing that we think about is like, even if in isolation as a pre-seed investor, we could have a great outcome with a company that sells for 50 or 100 million, right? And the founders could have a great outcome. if you get on this path of venture, eventually you're going to talk to investors who have 100 million fund size, and then 200 million, and then 500 million. And so every stage after that, the underwriting gets, different, right? The outcome needed to support a fund of that size changes significantly. And so we've seen this in the past, right? Because we've made this, these types of decisions firsthand in our early years too. Is occasionally you'll have a company that'll get to that, seed Series A stage, and the Series A investor is just like, I can't underwrite this, right? And so they hit a wall, and then all of a sudden you have to look for alternative means of raising capital for that business. So that's a bit more of like why that really matters, even for early stage investors. Yeah.
Right. How the system kind of works, which I think is fortunate.
Right.
I don't think it should be viewed negatively.
Yeah.
All right. Is there any, this is a lazy question, but thinking of like bad pitches that you've heard, been a part of, whatever it may be, any just like based on that feedback that you would give to founders broadly, hey, here's some commonly made mistakes?
Yeah, I hesitate to like just say, bad, but I would say, sometimes you just see something that feels like unformed, right? Like you kind of get on the call and you get the sense that like it's early to be having this conversation, right? And those ones are always a little tough, right? Because when we're being honest, we're just saying, I don't think like there's enough work that's been done at this point to sort of jump into these conversations, right? Like you could have done a bit more in terms of validating with customers, or, we went and phoned two people who would be prospective buyers, and their version of what's interesting in this market is very different than what you're saying, right? Mm-hmm. And so there's oftentimes mismatches that create elements of bad pitches, right? Mm-hmm. And then I would say there are certain things I come across. Like I said, obviously we value transparency. When we get the sense that people are not being transparent or being purposefully, kind of obfuscating things, that's not going to play well, right? Like if we ask questions and we feel like we can't get straight answers, there's no amount of work I can do on the back end to get our team excited about a company like that, even if broadly we think the market's interesting, right? Mm-hmm. So those are certain things that come up. And then I would say just, being prepared, right? We all use heuristics, right? And I think heuristics are ways of kind of, simplifying things. And so sometimes I think like those small things, like, showing up to meetings on time, like having a deck that's prepared that you've thought through, like having your materials like ready to go when you're going into investor conversations, all that stuff isn't going to be necessarily the make or break, but it definitely makes it way easier on our side, right? We can move so much faster when we get the sense that this founder has really gotten things together and is really prepared going into these conversations. To mention, I had one that I loved recently as an example of, what to do. And there's so many new tools nowadays, right? Like I'm excited when I find out about new tools from founders. Like that's how I learned about Loom. It's how I learned about, Notion in the first place, is I started seeing founders using these tools. And we had someone recently, they had recorded all these amazing demos with voiceovers in, Loom, right? And they just sent over this backlog that we could kind of review on our own time. And then they had a Notion that was probably, 10 pages of material long that was just breaking down like, here are all the elements of our pitch. Here's why the market's interesting. Here's the history of this space. There were like regulatory tailwinds and what they were doing, and they broke down everything with like the necessary links, right? And so things like that I think are really valuable, and it takes a lot of time off our side, but it also just gives us more of that feel of like, how does this person think, right? Which we have to, bet on at the end of the day.
Right. That's interesting. That sounds like an excellent, someone mentioned data room in the chat. That sounds like an excellent level of preparation that, speaks to the founder almost as much as to the company or problem they're solving. I'm going to layer in a couple of questions that I did see popping in the chat, and everyone that's listening, feel free to keep dropping those things in. We will try to get to as many of them as possible, but thinking about Amplify, maybe just help people share a little bit or learn a little bit more about you. How has your role switched or changed in the last, 7 years that you've been there?
Yeah. So in a lot of ways, I think when I first joined, there's a lot of imposter syndrome, right? I still feel that in a lot of conversations, right? When I first started out, I felt like it was hard to figure out where I could best contribute to the team. And a lot of the reason was you just need to kind of put in reps over time, right? As a founder, you kind of learn that when you're pitching investors, right? Like your first pitch, is not necessarily going to be a home run, right? And after you've kind of been through 20, 30, 50, 100 pitches, you start to feel just more comfortable in that sense, right? And I think on the investor side, that's extremely important. because there are so many different business models, right? There are so many different verticals. And I think a big barrier in the early days is knowing how to evaluate a company in a certain industry or a company with a certain business model, right? Because you just don't have as much pattern recognition at that time. And so I think a lot of it for me in the early days was just going deep on things. And I think I really appreciate our team being flexible with that, right? And taking a chance on giving me the opportunity to learn. Because it felt like the first year or two I was on the job, it was just a lot of reading, a lot of like studying companies. And there's a lot of material out there. There's even more nowadays. You have all these great podcasts, you have, awesome webinars, you've got like so much more content that's out there. But really just being able to have a period of time where I could dive deep and feel like I was learning a bit there was great. And then over time, other ways the role has shifted. I'm much more involved on the back end, right? Which I would refer, in our sense, like our back end means like how do you run a fund, right? Like how do you operate a fund, set a model, talk to LPs, pitch, prospective investors on why they should be excited about what we're doing. All of that was stuff that I didn't touch for the first 3-4 years that I was doing this, right? And that only shifted, that long into the job, where now I spend a lot of time thinking about like, what does it mean for us as a business to be successful over time, and how do we operate and run things efficiently? There are other ways, right? Like we've had team members kind of, come, go over time. And so there's a lot of like learning involved in that when you take over other roles and responsibilities, when you hire new people onto the team, managing people for the first time, that's always, exciting and terrifying. So those are like great parts of the job and how it's changed for me.
Mm-hmm. Yeah, that's interesting. I think that's another good perspective for everyone to keep in mind. It's just, there's two sides to a venture firm, right? There's the founders and how you support them. Yeah. And then there's the LPs, which are just as important. And, but anyway, okay, cool. And then I'll just jump right into it. I mean, decision-making process at Amplify these days, what does that look like for you guys from meeting a founder, hearing about them, and your role in that?
Yeah. Our team on the investment side, we have 4 investment team members. And so the way to think about it is we're all going to take pitches separately, and then there has to be like a consensus process. And so, occasionally founders will come through me first. They'll come through, Olivia on our team, or Paul, or Aded. And then over time, we, meet every week when we do effectively like a long internal session where we're talking about companies. And there's a lot involved in that, right? We're typically putting together an early memo, why we're excited about a company. We're doing some of that early customer validation. And then once things sort of percolate to the level where we say, it's enough for not just 1 or 2 of us to have met, but we need the full team in on this. Okay. And we set up, a pitch with the entire team on our side. And so we want everyone on the team to have a direct touch point. And oftentimes that's, wrapping in more people from the founder side, right? If we've only talked to one co-founder, it could be bringing everyone else in, right? So those are aspects of it. And then generally, I would say like after our entire team has met, we've done some of that customer diligence. We've talked to other founders in our network who know a space really well, right? Like all of that part of the process is done. It's sort of, can we arrive at a deal that makes sense, right? We want the team to be excited. We want to be excited. And so there's a lot of kind of like legal and closing and financial diligence that goes into the last bit of that, and just arriving at, okay, we have an offer, we can move forward.
Okay.
Generally, I would say process like 2.5 to 3 weeks. Okay. I would say it's typical for us. We've gone as fast as a week where, stars align and everything's going really, really quickly, right? And then occasionally it takes a little bit longer, right?
Right. Yeah, that is interesting. I mean, I guess it makes sense too, because I'm a little bit surprised to hear, maybe surprised is the wrong word, but that all four investing partners do meet the founders before you make a decision. But you know, early stage investing is people driven, right?
Yeah. In every case I can think of for us. And it isn't that way in all firms, right? There are a lot of firms out there where you can meet a percentage of the people, right? And you can get a deal done. For us, we make sure everyone has had a chance to, connect, right? And so I think for that side of it, people are really flexible, right? We've had partners take calls in the middle of the night if it worked out for the founders, right? So if it's like really holding things up, we're going to find a way to get it done. And the teams are usually accommodating on that. So that's something that like we always want to insist on, because we do make decisions by that kind of, that team model, right? Team driven model.
Yeah, that makes sense.
We've had situations where it's like a 3-4 vote and we've still moved forward in the past, right?
Okay.
Where you can have odd ones out, but people really just say, I believe in this, and I'm willing to, kind of move forward and put everything out there. But, most of the time we're sort of finding a way to get to consensus within our team.
Okay, that's interesting. I mean, it makes sense, and I like the idea of, it's a lot of steps. Maybe 2 or 3 years ago, whenever the VC market was crazy, I'm sure some founders were expecting to move a little bit faster, but you guys probably are looking for founders who value the partnership that Amplify brings, so that it becomes a good relationship, which is a perfect transition into my next question. How does Amplify support founders, like beyond just cash?
Yeah, I'll talk about that. One other thing that is really relevant in that question that you asked just now is founders are doing their diligence too, right? And we want to support that. And I think one of the most powerful things that we do in our process is if we get to the point where we're ready to move forward with the company, we provide the opportunity for that founding team to meet with any of the companies that we've worked with previously. And that's not us going to the founder and saying like, hey, here are 3 companies that you can talk to. Here's our references, right? We want it to be fully open book, right? Talk to anyone that we've worked with in the past, good experience, bad experience, company failed, company did well. And we want you to have the chance to talk with them. So we'll facilitate those. We provide the contact info and we respect that part of the process, right? At the end of the day, like you should feel like you're able to make a really informed decision. And I always coach founders that we're talking to that one of the best things that you can do is ask those questions of the investors you're meeting with, right? Ask to meet with people that they've backed previously. If it's strategic and that person's in the same industry that you are, or even if you just want to hear about a case where, hey, something didn't work out with one of your portfolio companies, what was that journey like? Can I talk to this team? And I think if you find that investors are kind of cagey and not being transparent, it's like the same thing that I said on our side, right? It's a 2-way street, and so you should definitely expect that of the investors that you meet with and talk to.
Yeah, that's great transparency. I feel like every founder should feel empowered to ask that question. And to your point, they're cagey. Yeah, they've probably been cagey for a reason.
Yeah. And then the other part of your question, totally. So as far as how we're supporting companies, a lot of that is going to depend on the industry that the company's in, where they're at in their growth stage. For some companies, it's all hands on deck for hiring, and we're kind of scouring our networks and trying to connect great people into companies. There've been a lot of cases where we've helped with like senior hires, building out that early exec team. There's a lot of it which is focused on customers, so new customer introductions. We sort of start in the internal circle, right? Can we connect in a lot of our existing portfolio companies that we think would be relevant customers, and then can we kind of like build out from there? And it's great when we find synergies in portfolio companies. We've had portfolio companies do formal partnerships and bundle products together in the past, and co-sell. Those are arrangements that we love to help with. And then a big part of it is fundraising. So being prepared to raise that next round, the round after that. Even some of our companies that are Series C, Series D stage, we've made introductions to lead investors and been a big part of getting those late rounds closed. So we really do, we say it's like a marriage, right? Our early companies from Fund 1, now we're 12, 13 years into it, and we're still on the phone with those founders and seeing where we can help out if we can. So it's really just, a lot of times driven by the company. We have an internal model, squeaky wheel gets the grease. We want our founders to be vocal, right? And we want you to talk to us about the good things, the bad things. We want you to raise problems, raise issues. We'll ask as much as we can, but we also want it to be, that our companies feel comfortable reaching out to us at any time with anything.
Okay, great. I like that. Good or bad, have the confidence that you guys will be supportive. And that's, I guess probably a classic question that you guys would get, or at least people would wonder about an early stage first check fund like you, is the connection to the next round of funding. Like, why wouldn't I just go to a massive fund that has a first check fund as well as the growth stage? I can keep it all in house. So my guess is that you've got some strategies. I don't know if it's appropriate to ask if you guys work with later stage funds, but what's your thought process on that?
Yeah, we split up, right? Like we spend probably a third of our time talking to, founders or more. A big bucket of that time is talking to other investors, right? Because other investors are a great referral source for us. And then we always are referring our companies to other investors. And then a lot is spent, like I would say, talking to a broader group of operators and founders for diligence, for other reasons, like keeping tabs on, the angel community and certain company communities that we want to be a part of. So like Snap here in LA, we spend a lot of time talking to folks who are over in Snap's ecosystem, right? It's a great pool of talent locally.
Yep.
And so it's a lot of what we do, right? We're trying to find, a lot of high value introductions for our companies. And so it's all the better when we can kind of get to know an investor over time, have a good sense in our minds of what that fund is looking for, and then have a portfolio company that matches well with that thesis, right? And those are the best introductions on our part. Yeah, and I would say definitely warm introductions are better than our founders having to like go and reach out themselves, right? And so where we can be that router and we can connect our founders into all these other investors downstream, and it's really helpful. I think it increases the odds immensely that that person's able to get in touch with all the different folks that they're trying to reach at those firms.
Yeah, definitely. And you guys become sort of a reference for them, which is exactly what you had alluded to, right? The people-driven aspect of it, if the investors are happy with the founders, even if the company is, doing one thing or the other, I think that's really important.
And we're asked to do formal references on our companies all the time. So downstream investors want to talk to early investors. We'll have Series A, Series B funds that'll call us up and just ask for the early bits of the history, right? Because there's almost like a part of that, narrative around the company that they're trying to figure out, right? And so oftentimes we're the ones who are closest during that period.
Okay, great. Let me. I've been creating a little list of some of the questions that have rolled through the chat as I grab them. So I'll rapid fire a few that I think should be quick answers, and things that you may have already covered, Connor. So I appreciate you bearing with me. But what geographies do you guys invest in? Is it only LA?
Majority LA. So probably 2/3 of what we do is LA based. And then we do invest more broadly than that, but it tends to be companies that are outside of Boston, New York, or SF. So big part of what we learned over time, going back to the bit I mentioned about history, right? Why we started the need in the market is effectively a lot of ecosystems are in the same place that LA was when we started Amplify, right? So 2011 to 2014 LA looks a lot like if you look at like Atlanta now or Nashville or Portland or even Seattle to a certain extent, right? And we've made bets in all of those ecosystems because I think when you look at the capital providers in those places, there isn't a huge pre-seed ecosystem, right? There aren't a lot of first check funds that are taking bets on companies. So over time, it was almost an emergent thing. We started to notice we were getting more pitches from those places. And then we also noticed that there's like migration patterns over time. So we have these great operators and founders that we're really close with and we backed, multiple times in some cases. And maybe one of those people moves to Nashville and is now a resident there. That was the case with one of our venture partners. And so all of a sudden we started to get like a ton more introductions to companies in the Southeast, right? And so we're not going to, bar ourselves from looking in those cases. But we have a pretty broad mandate there, right? We want to have, it's more driven for us, right? We want to have a lot of in-person time with our founders, right? I think for your early stage investors, you should expect that, right? Oftentimes it's not as helpful if you have people from across the country kind of phoning it in. So the other exceptions that we make all the time are founders who have a compelling reason to be in the LA market, right? A great example of that has been, people in manufacturing tech, right? You're going to spend a lot of time in LA, freight and logistics, warehousing, right? Huge in LA. We have a, multi-trillion-dollar economy, and a big part of that is logistics. And so if you're doing anything in that wheelhouse, you're going to spend time here. So those are cases where we've made exceptions. So short answer to the question, it's nebulous, right? It's pretty broad, but the majority of our companies are Southern California.
I like the way you're thinking about it too, because obviously the LA ecosystem is the opportunity that you guys saw when you started the firm. But recreating that model, supporting companies in similar markets as they blossom, that's great. And from the chat, someone must have missed it, but you guys are currently investing, right? Yeah. What fund are you guys investing out of? Someone may have done some research. They said Fund 5 from 2022. Is that the current fund?
Yeah, Fund 5 is our current fund. It's about 32 million in total capital. We've made, I think, 21 investments out of that fund to date. We'll probably make another 7 or 8 investments out of that fund, and then look to raise another fund after that. And so about 2/3 of the way through deploying that fund. So yes, actively investing. We're taking pitches near every day. Yeah.
Great. And then industry agnostic, we talked about a little bit. You guys are all sort of jack of all trades, master of none. And what types of investments do you guys make? Like there was a question about, do you guys do convertible notes? Do you guys always do kind of the same structure since you're the first check-in? What's the thought process?
Yeah, speaking of how the venture landscape has changed, that's a huge aspect of it. I would say, when I first started, almost all of our investments were on notes, and it's completely flipped to safes, right? So I guess credit to YC. YC has really popularized the safe as the instrument of choice for early rounds. And I would say it's a good thing in the sense that it's way easier, right? It's a lot simpler for founders to just go and put together a post money safe and get on their way. There are still things that like we in transparency will always flag as warning signals to early founders. We have a law firm partner on the partner side here who can probably attest to this. But when you stack post money safes, there's a recipe for disaster, and we see that bite companies a lot. And so I think there are still elements to be aware of there. But we've done a mix of all different kinds of instruments, right? We had a standard note for a long time that we used. So we've just gotten to a point where the language was good, and we felt like we had kind of ironed out all the details there. Now it's majority like post money safes, or even the old YC safe, the pre-money effective safe.
Right.
And then occasionally we'll do priced rounds, usually only if the round, kind of justifies it. You'll sometimes see pre-seeds that are 2.5, 3 million. And in those cases, we'll kind of talk to the other investors involved. And if it makes sense to structure it as a price round, we'll opt for that.
Okay.
But we're flexible in structure.
Okay, flexibility makes sense.
Yeah.
We just had I had two questions. People in the chat are sort of calling us on. That's apparently the Amplify website. All the areas you guys focus in must just be software based listed, but you guys are open to hardware. I think we've talked about and consumer product.
Yeah. Early days, we did more CPG investing. So we had a couple companies in Fund 1, Fund 2. Part of it is, honestly, if you look at like the trends over time in LA, right, there were definitely different things in vogue, right? And so in the early days when we started, it was a lot of media, entertainment, gaming, mobile, and then CPG, right? A ton of CPG founders in LA. Over time, we found that we were more comfortable doing kind of the commerce enablement side of it. So we saw the huge boom where all of a sudden it went from founders would use Shopify and then always talk about, hey, we're going to migrate off Shopify eventually, right? Eventually we're going to go to, homegrown solution. And then we just saw that chorus kind of decline, and we realized like, wow, this is really the infrastructure for commerce in these cases. And so a whole ecosystem of companies sprung out on the software side to support commerce use cases. So I think we started to do a lot more of that type of investing. Definitely the majority of what we do is software, right? Across different industries. That could be consumer facing software. It could be, what feel like very niche areas. But we're still, we have the latitude to look at anything. We did our first like biotech investment in the past year. And I would always say on calls, like, we're never going to do biotech. And we did our first one. And so you really learn over time, never say never, right?
Okay, there you go. I like it, the flexibility. That's what Amplify is. Flexibility, supporting founders early on. I like that. So Amplify, next 12, 18 months, like what are the different goals that you guys have? I mean, you guys are flexible on industry. Are there specific industries that you hope to open up into? Anything on like kind of what you guys talk about in the future plans of the firm?
Yeah, there's a lot. Operationally, we're kind of in the like last third of our current fund, so we're going to have to be preparing and going out to market for a new fund pretty soon here. So that's a lot of what we're thinking about and spending time on, at least internally. A lot of our companies don't raise in November and December. I don't know if it's really because the market shuts down, or everyone just says the market shuts down, and so it's kind of the effect of you hear it so often that you make it true. And so I would say there's definitely that overhang of we have a lot of companies getting ready to raise in Q1 of this year. So we're spending a lot of time there. And then I would say longer term, we're still thinking about a lot of what's going on. I mean, this is like a really interesting time to be in tech on either side of the fence, right? I think AI is still a huge question mark for a lot of folks in terms of like how exactly value accrues over time, right? And it's sort of becoming like table stakes that people are experimenting with it and trying to figure out their own strategies. But I still think there are a ton of questions on our side, right? Like, what are the industries that are most exposed to it? Where are we most likely to see like regulatory headwinds as opposed to tailwinds, right? Where people really start to kind of crack down sooner. I think that's been a worry in, legal tech as an example, right? And so you have really active, kind of governing regulatory bodies there, right? Who I think want to make use of tools, but also want to see like very kind of defined use cases. And so I think those are things that we're paying attention to, interesting conversations going on. There's been definitely a hardware and manufacturing renaissance, which I think is driven by a lot of, if you look at the US overall, right, we're doing a lot of onshoring, reshoring.
Yeah.
There's a huge emphasis right now in government programs going to funding, US manufacturing in all different spaces. And so there's a ton of like interesting tailwinds there in categories that I don't think people were investing as much in the past 3-4 years. So there are some things that we're paying attention to. And then, broadly, it's always, the next great company that we're going to meet. So we're spending a lot of time just networking, talking to founders, talking to operators, other angel investors, institutions, always looking to meet great people building in those really early stages. Yeah.
Okay, awesome. Well, cool. Well, a lot of the questions in the chat, which is great for the activity. A lot of them are, fairly specific. So I don't think it's helpful for other people to start covering things one off. But what I will say, a common question that we keep getting is, how do we contact Connor? I think the best way to contact Connor, LinkedIn or Twitter. Is that fair to say?
Yeah. We always check like inbound there. I would say definitely reach out over LinkedIn or Twitter. I still say like the best, way is always getting like a referral from someone that, is in our broader network. If you see we have mutual connections and it's for like the purposes of a pitch, that's always great. It helps on my side because I think one of the things that happens over time, right? You just get a lot of inbound from various sources. And so when we have people that we're working with and talking to on a regular basis, who are saying like, hey, you should meet with these folks, it helps, right? But that being said, like I review all of the messages that I get. And so it's a huge source for us over time. So that's super easy. I think we can share, contact info in cases after this with the group too. But we're pretty easy to reach overall. There's also, I think, a way on our website to create like a submission about a company. And so that's another source that like we're reviewing, every day as well internally.
Okay, great, cool. I'm going to drop Connor's.
So we'll make sure
LinkedIn
everyone has
chat.
the relevant info after this.
Yeah. So here's Connor's LinkedIn, so everyone can find him. You can navigate through that to the Amplify website. Feel free to drop him a note, however you guys want to make the case. Obviously, everyone on here knows it's a competitive world in the early stage VC stuff. So you guys have mutual connections. That's great. And then wrapping things up, another thing thank you to all the partners that are on the call. Like I mentioned, it's Kate Kozak from Trinet, Alex Daniels from Decrypted Law, Bruno Cunha from ARC Finance. Feel free to reach out to us at Escalon directly and we can get you connected wherever you guys need to go. But I appreciate everyone joining, and Connor, thank you very much for the time.
Thank you all. I really appreciate it. It sounded like we had a great group on the call and lots of good questions. So please, keep in touch, reach out. Would love to have more conversations with this group.
Awesome. Great. All right. Well, thank you, everyone. Have a good one.